Welcome to the deep dive. Get ready, because today we're plunging into something that's definitely hitting pocketbooks and boardrooms.
Yeah, we're talking about the potential economic fallout from those U.S. tariffs announced back in March and April of 2025.
It's a big one. Touches on trade, finance, investment.
And ultimately, how economies and households fare.
Right.
We've got a fascinating stack of analyses you provided research from the Center of Policy Studies, COPES.
Right.
A working paper from the National Bureau of Economic Research, the NBER.
Okay.
And insights from the Penn-Wharton Budget Model, PWBM. We're basically going to act as your guides through all this complex stuff.
Yeah, our mission for this deep dive is pretty simple, really. We want to take these analyses, understand the different ways they look at the problem.
The models they use.
Exactly. And pull out the most important findings. How might these specific tariffs impact economies, both here in the U.S. and, globally?
And what that could mean for you, looking at different time frames, too.
And we should probably say up front, tariffs are an economic policy.
Right.
These sources give us economic analysis of what might happen. We're focusing purely on what the data and the models in these papers are telling us.
No political takes here. We're just here to unpack the findings you gave us.
Okay, so let's unpack it. First things first, we need to be clear on exactly which tariffs we're talking about. The COPES paper seems like a good place to start for that.
Yeah, it's really helpful because these weren't like brand new tariffs out of the blue. They were significant rate increases announced in March and April 2025.
Increases, so on top of what was already there.
Exactly. Added on top of existing tariffs, like the ones the U.S. put on China back in, 2018 to 2020? Those are already baked into the baseline in these models.
Gotcha. And the scale of these new increases sounds pretty dramatic.
Oh, it really is. I mean, look at the COPES model. The average baseline U.S. tariff on stuff from China was about 18%.
Okay.
These new increases added roughly 145 percentage points.
Whoa!
Yeah, the total level they're simulating in their policy scenario shoots up to around 163% for imports from China.
163%. That's massive. And, actions like that tend to get a reaction, right?
They definitely did.
Yeah.
Trading partners China, the EU, Canada, Mexico, they announced their own retaliatory tariffs.
Right. Tit for tat.
Pretty much. The COPES paper notes that, for example, China's average tariffs on U.S. imports went up by about 125 percentage points in response, bringing their total level to around 140%. And the EU's retaliation, that's factored into, effective from mid-May 2025 in their model.
So you've got this, escalation, significantly higher tariffs going both ways.
Exactly. It's a complex picture.
So how do you even start to model the economic effects of all this? These different sources, they use different kinds of economic models, I gather.
They do, and that's really key. It helps explain why the findings, while generally pointing in a similar direction, have slightly different focuses and nuances.
Okay, so tell us about them. The COPES study.
Right. COPES uses the GTP-affine model. You can think of it as this sophisticated dynamic global model.
Dynamic meaning it looks at changes over time.
Yeah, exactly. It looks at global trade, international finance, how economies adjust over a longer period they project out to 2040. It's designed to capture those complex international links.
Okay, so that's the big picture, long-term global view. What about the NBER paper?
NBER takes a bit of a different approach. It's more grounded in theory and empirical evidence, often using a model type applied to smaller, open economies. But its core ideas about protectionism are pretty broad.
And it looks at different features.
Yeah, it brings in things like sticky prices.
Yeah.
Prices don't adjust instantly in the real world.
Right.
And it looks at how firms behave, focusing maybe more on the business cycle effects, the shorter-term fluctuations.
Right. And the third one, Penn-Wharton budget model.
PWBM used their own model. It's specifically built to look at the long run, sure, but also the fiscal impacts, government budgets, debt, and crucially, the effects on household welfare. Their projections go way out to 2054.
Wow, okay. So COP for the global trade dynamics over time. NBER for maybe the business cycle and price stickiness. And PWBM drilling down on the long-run fiscal side and what it means for households.
That's a good way to sum it up.
Using these different lenses should give us a much richer understanding than just relying on one single perspective.
Absolutely. They highlight different cause and effect channels.
So let's start with maybe a core principle. The NBER paper, you said it builds on evidence about protectionism generally. Well, what's the main takeaway there?
Well, their analysis really reinforces a common finding in economics, which is that protectionism, it tends to be recessionary and inflationary.
Recessionary, inflationary. That sounds pretty bad, like the worst combo. Less growth and higher prices. How does that usually work?
The basic idea is fairly straightforward. Tariffs make imports more expensive, obviously.
Right.
Now, that might cause people to buy more domestic goods instead, shift demand. But, and this is crucial, it also jacks up costs for businesses that need imported parts or materials.
Ah, okay. Supply chains.
Exactly. And it can hurt your own exporters too, right? Either because other countries retaliate with their own tariffs,
Like we just discussed.
or just because global trade slows down overall. So the net effect, it often acts like a negative shock to the supply side of the economy, disrupts things, raises costs.
Okay, like throwing sand in the gears. And what about the idea that tariffs fix trade deficits? Does the NBER paper find support for that?
Well, in their empirical analysis of protectionism, they found, and I'm quoting roughly here, at best, a small positive effect on the trade balance GDP ratio.
So not a major lever for that in their view.
Doesn't seem like it, based on their findings.
And did their models suggest this holds true even in weird economic times, like near zero interest rates?
Yeah, they checked that. Even in scenarios like interest rates being pinned near zero, the protectionist shock in their model still looked contractionary, still reduced output.
Okay, so NBER gives us this general idea. Protectionism often acts like a negative supply shock, potentially leading to lower output, higher prices. Now let's take that idea and apply it to these specific March-April 2025 tariffs using the Copy S paper's detailed GTAP-affine model. What do they see for the U.S. economy, say, out to 2040?
Well, their finding is pretty stark, really, across all the different scenarios they modeled.
Yeah.
These U.S. tariffs have a negative impact on U.S. real GDP. No ambiguity there.
How big of a negative impact are we talking on average over that, 15-year period?
The average annual losses are projected to be around minus 1.3% of GDP if there was no retaliation, which is hypothetical, of course.
Right.
In the more realistic scenario with retaliation, it's about minus 1.4%.
Okay.
And even if the government uses all that tariff money to pay down the deficit, what they call the fiscal consolidation scenario, the average loss is still around minus 1.25% per year.
So even if you use the revenue productively, quote unquote, to reduce debt, it still doesn't wipe out the negative GDP effect from the tariffs themselves.
That's what their model shows, yes.
Why? What's driving those losses in the Copy S model?
It's a mix of things.
Mm-hmm.
In the shorter term, you get a hit to employment because wages are a bit sticky. They don't adjust instantly.
Okay.
But over the longer run, the main drivers are, one, a smaller capital stock, basically. Businesses invest less.
Right, less investment.
And two, something economists call allocative efficiency losses.
Allocative efficiency losses.
Okay. Sounds a bit technical. Can you break that down for us?
Sure. Think of it like this. Tariffs are barriers. They distort the natural flow of trade and investment. Instead of capital and labor going where they'd be most productive globally.
They get steered by the tariffs instead.
Exactly. They get allocated artificially, not efficiently. And that misallocation imposes a real cost on the economy. It means we're not making the best use of our resources, which ultimately drags down potential growth. Got it. So less investment plus resources not being used in the smartest way. That adds up. Now, you mentioned the NBER paper didn't see a big effect on the trade balance overall. What does the Copy S model show for actual U.S. trade volumes, imports and exports?
Yeah, this is interesting. The Copy S model does project a big drop in U.S. import volumes, down about 11% on average.
Okay, that makes sense. Tariffs make imports expensive.
But U.S. export volumes are projected to fall even more, down around 14% on average.
Wait, hang on. Exports fall more than imports. Isn't the whole point of tariffs sometimes argued as, reducing the trade deficit by cutting imports more than exports? That seems backwards.
It does seem counterintuitive at first glance, yeah. But in a complex global model like this, you have these other forces. Retaliation directly hits our exports.
Okay. The other country's tariff.
Exactly. Plus, when global trade shrinks overall, and given the U.S. started with the trade deficit, the way the adjustments work out in this model means the export side actually takes a proportionally bigger hit in volume terms.
So the takeaway is imports fall, sure, but our ability to sell our stuff abroad gets hammered even harder, partly canceling out any intended effect on the trade balance.
That's a key part of the dynamic in their projection, yes. It suggests it's not really a win for the trade balance, and it's certainly a blow to export-focused industries.
Okay, that makes more sense now. What about the prices? The terms of trade, the price of our exports relative to our imports?
Well, if there were no retaliation, the model suggests the U.S. might see a small improvement in its terms of trade.
But there is retaliation.
Right. And with retaliation, The COP-PS model projects a significant terms of trade loss for the U.S., averaging around minus 0.88%.
Ouch. What does that mean practically?
I mean, U.S. exporters are effectively getting lower prices for their goods when they sell them overseas because of those retaliatory tariffs they face abroad.
Lower prices for our exports. Okay, so how does all this lower GDP, messed up trade flows, worse terms of trade, filter down to actual spending, consumption, and investment in the U.S.?
Well, according to the COP-PS model, U.S. real consumption, what households actually buy, declines in all the scenarios. And that decline is worse under retaliation and real investment. That also takes a substantial hit, projected to fall by around 3.15% on average under the retaliation scenario over that 2025-2040 period.
And that drop in investment is key, right? Because that links back to the smaller capital stock you mentioned earlier, which hurts future growth.
Precisely. It feeds that long-term negative impact.
You also mentioned that fiscal consolidation scenario using tariff revenue to cut the deficit.
Right.
You said GDP losses were slightly smaller, but consumption losses were initially deeper. Why is that?
It's an interesting trade-off. Using the revenue to pay down debt increases the national savings rate.
Okay.
Which is, fiscal responsible and slightly cushions the GDP hit from the tariffs themselves over time. But it means that money isn't being spent by households immediately. They're effectively saving more.
So less spending now.
Right. So consumption takes a bigger initial hit compared to if the government just spent the revenue or gave it back somehow. It shifts the pain a bit.
Fascinating how these things interact. Okay, so for the U.S., COP-PS points to contraction, less trade overall, exporters getting hurt, lower consumption, lower investment, especially with retaliation. But these tariffs weren't just a U.S. thing, given the global scope and retaliation. What about the impact on other economies?
Yeah, the global spillovers are a big part of the story. The COP-PS model is great for seeing this.
Yeah.
Let's look at China, for example, since it was a major target of the U.S. tariffs.
How does China fare in their projections?
As you'd expect, not well. The COP-PS paper shows China facing a pretty significant terms of trade loss, about minus 1.3% on average, even without retaliation factored in on their side initially.
And that loss hits their income.
Directly. Reduces China's real national income and consequently their consumption. They also project real GDP losses for China, around minus 0.37% on average under the retaliation scenario. That's worse than if there were no retaliation.
And consumption.
Consumption losses are bigger with retaliation too, averaging around minus 0.67%. So yeah, a clear negative impact on China.
Okay, that makes sense, being a direct target. What about countries maybe less directly involved? The COP-S paper looked at Australia, right?
It did, and this is quite interesting. Australia is modeled as relatively insulated, partly because they don't impose retaliatory tariffs in this particular setup.
Okay.
And interestingly, the COP-PS paper projects a small short-term boost to economic activity in Australia in 2025, especially investment, which gets a bump of about 0.95%.
A boost. While the U.S. and China are taking hits, how does that work?
It's basically a reallocation effect. Global investment capital is looking for returns, right?
Sure.
When investment prospects dim in the U.S. because of the tariffs and maybe uncertainty, some of that capital looks for opportunities elsewhere.
And some flows to places like Australia.
Exactly, giving them a temporary lift.
Yeah.
However, it's not all good news for them long term. Over the full period, Australia still faces some terms of trade losses and slightly lower average real consumption.
Why lower consumption if GDP is slightly higher?
Well, partly because some of the returns on that extra investment capital flow back to foreign owners, not Aussie households. So the picture is nuanced.
So a temporary positive spillover from capital shifts, but still facing some long-term headwinds. What about the EU? Similar story.
Pretty similar dynamic, yes. The EU also sees a modest, but again short-lived bump in activity in 2025 in the COP-PS model. Same reason. Global investment reallocating away from the contracting U.S. market, some finding its way to Europe temporarily.
Okay, so the ripples are complex, direct targets get hit hard. Bystanders feel effects too, maybe some short-term positives from capital shuffling around, but also facing longer-term pressures like terms of trade. Right, let's switch gears a bit to the Penn-Wharton budget model, PWBM. They look even further out, right, and really focus on households.
That's right. Their analysis goes all the way to 2054, a really long horizon. And yes, they put a sharp focus on the U.S. economy and specifically household welfare. And their findings are pretty stark, especially for the long run.
Okay, what are the headline numbers from PWBM?
They project these tariffs will cut long-run U.S. GDP by about 6% and cut wages by about 5%.
Wow. 6% lower GDP, 5% lower wages? permanently in the long run. Those are really significant numbers. How does that translate down to, an average person?
PWBM tried to make it concrete. They estimated that a typical middle-income household could face a lifetime loss of about $22,000.
$22,000 over a lifetime. That definitely makes the abstract economic models feel much more real. What's driving such big long-run hits in the PWBM model? Is it different from copyists?
There's overlap. But PWBM emphasizes a couple of key channels. Like the others, they see the direct burden of the tariff itself, the tax that someone has to pay.
Right. Consumers or businesses.
But a huge factor in their long-run numbers is the impact on capital flows.
Capital flows again. How do tariffs mess with those in their model?
So their logic goes like this. When the U.S. buys fewer imports because of tariffs, foreigners earn fewer U.S. dollars, which means they have fewer dollars to recycle back into the U.S. economy, for instance, by buying U.S. government bonds.
So foreigners buy less of our debt.
Potentially, yes.
Yeah.
And if foreigners are buying less government debt, who have to buy it? U.S. households and institutions. So more domestic savings get channeled into buying government debt, which means less domestic savings are available for investing in private productive capital. The factories, the equipment, the technology that actually boosts productivity.
I see. So savings get diverted from productive investment to funding government debt instead.
That's the channel they emphasize. And this diversion leads to a really significant projected decline in the overall U.S. capital stock in their model, nearly 10% lower by 2054 in one scenario.
And less capital per worker? That means lower productivity?
Lower productivity and ultimately lower wages and lower GDP. It connects back.
Makes sense. Did they look at uncertainty too?
They did note that. They estimated the rise in economic policy uncertainty around March 2025, which they linked to these tariff talks. Probably reduced investment by about 4.4% just in 2025, though they assume that specific uncertainty effect fades out over time.
PWBM also made a comparison, didn't they, between these tariffs and raising corporate taxes.
Yes, and it's a really striking comparison. They looked at what would happen if you raised the corporate income tax rate from 21% all the way up to 36%.
Yeah.
That's a big hike, often considered quite economically damaging.
Right.
Their estimate. The tariff policy reduces U.S. GDP and wages by more than twice as much as that huge corporate tax increase would, even assuming the tax hike raised similar amounts of government revenue.
Wow. Let me get that straight. Their model says these tariffs are potentially twice as damaging to long-run GDP and wages as a massive corporate tax hike that raises the same money.
That's the finding from their specific model, yes. It suggests that from an economic efficiency standpoint, tariffs are projected to be a particularly costly way to achieve policy goals or raise revenue.
And who feels the pain? Is it spread evenly?
Their distributional analysis concluded that, quote, almost every household is worse off under these tariff scenarios. It wasn't concentrated on just one group.
But tariffs do bring in money for the government, right? PWBM estimated trillions over 10 years. Doesn't that count for something?
It does bring in substantial revenue, yes. Over $5 trillion conventionally over 10 years in their estimate. But their overall conclusion is that the economic costs, the lost GDP, the lower wages, the inefficient use of resources are projected to be much, much higher than any benefit you get from using that revenue, even if you use it to reduce the federal debt.
It comes back to that idea of efficiency or inefficiency in this case.
Exactly. Compared to other ways of potentially raising that revenue, their models suggest tariffs are a very inefficient method with large negative side effects on the economy.
Okay, let's try and pull all these threads together. We've looked at COP-ES, NBER, PWBM, different models, different time frames. What's the sort of overarching message emerging from this whole stack of sources?
Well, despite the different methodologies, the picture is remarkably consistent, really. Across the board, these analyses point towards significant negative economic consequences for the U.S. economy stemming from these specific March-April 2025 tariffs.
It keeps coming back to that NBER idea, doesn't it? Protectionism acting like a negative supply shock.
It really does resonate through the findings. You see projections of reduced economic output, a definite hit to investment and the capital stock over the longer term that came through strongly in both COP-ES and PWBM.
Right.
You have the potential for upward pressure on prices, the MBER finding. You have reduced trade volumes overall. and ultimately a direct negative impact on income and consumption for households.
And it's not just a U.S. story. The impacts ripple outwards.
Absolutely. The global nature of it all, especially with the retaliation, means significant spillovers. We saw the projected losses for a direct target like China, but also the more complex mixed effects for places like Australia and the EU, with those short-term capital reallocation boosts, but other pressures too.
It really sounds like these models are painting a picture of a long-lasting drag on the economy's potential to grow.
That's definitely a key takeaway, especially from the COPS and PWBM analyses that look further out. That long-term hit to investment in the capital stock is what limits future growth.
And we should probably remember these might even be cautious estimates.
That's a fair point. Some of the sources mention things they didn't fully quantify. COPS noted they didn't model the full impact of investor uncertainty, which could make the costs higher. PWBM also mentioned assumptions, like maybe minimizing short-run disruptions, or how different assumptions about trade sensitivity could change the numbers.
So the reality could potentially be even tougher than these already quite negative projections.
It's certainly a possibility that the sources themselves acknowledge.
Okay, well, this has been a really thorough deep dive. Based on everything we've covered from these different analyses, the strong consensus seems to be that the tariffs announced back in March and April 2025 are projected to have pretty significant negative impacts on the U.S. economy globally, imposing substantial costs. GDP, wages, household welfare.
And costs that, according to PWBM at least, could be much higher than other ways of achieving similar policy goals, like raising corporate taxes.
That summary seems to capture the consistent message we're hearing from these different perspectives.
Yeah, I think so.
It really makes you think about the underlying economic equation, which leaves us with maybe a final provocative thought for you, the listener, to chew on.
Go on.
While governments can definitely raise money using tariffs, we saw the trillions projected. These analyses strongly suggest that the cost to the broader economy might far outweigh those direct financial gains.
The costs being paid through, reduced efficiency, lower investment, slower growth.
And ultimately, less income for households.
It really prompts that fundamental question. What are the actual economic trade-offs you're making when you lean heavily on tariffs as a policy tool, especially given the potential long-term damage to the economy's productive engine, that capital stock we talked about?
Yeah. Think about all those channels we discussed, the supply shock idea, the shrinking trade, the hit to investment via capital flows, the drag on household income over a lifetime. It's a complex web, but hopefully this deep dive into the data has helped you get a clearer handle on those potential consequences.
We certainly hope exploring the source material you shared in this way has been valuable.
Thanks for joining us for the deep dive.